Welcome to the podcast, everybody. Thank you for joining me. I had somebody the other day say, "Hey, you don't do as many podcasts as you used to," and yeah, I'm busy. I'm trying, folks. I'm trying, but we got the radio show. Of course, I've got a day job of actually managing money for people, and then we do the podcast when we can. And really, sometimes I'll do them when there's something really big going on. And right now wouldn't be one of those times, would it? There's nothing really big going on. The markets aren't real turbulent. There's not a bunch of stuff happening. But having said that, markets are still moving, and there's still some things going on, some individual things. And I guess most importantly is still, besides the geopolitical risk, we still have interest rates are still in the headlines. And today we got the ECB, got the rate decision and kind of what they're thinking about doing. And of course, they're slowing down, so they're contemplating quantitative easing and all these different things. And meanwhile, globally, interest rates continue to fall. So you have the global interest rate picture continuing to fall, which if you look at our interest rates in the United States, we're still at 2.45%. Now that sounds really, really low to many of you, and it is, but when you take in consideration that many other places around the world that frankly are in worse shape than us, and they're having more demand for their bonds, and so their interest rates are even lower. So ours still looks like a good deal compared to theirs. Now, the news probably the biggest news of the day besides the ECB was David Tepper, the Appaloosa hedge fund manager. He was the one that had basically said about a year and a half ago, hey, look, if the economy is bad, then the Fed will be there. If the economy is good, then great. Stocks will go up because the economy's good. So either way, stocks are going to do well. And he was right. Now he's not as warm on stocks, but he is still saying, hey, what the ECB is doing, he said he thinks this is going to be the beginning of the end of the big bond bubble. And money will come out of bonds and maybe continue to go back into stocks, or continue to go into stocks, I should say. Who knows? I don't know if this is the end. Of course, we know that if you look at rates over a long period of time, you will see that they continue to fall, and they are very low levels. But now we know the middle of 12 may have been the ultimate bottom, but are we going to see a situation where interest rates start to take off and head up? We actually, in one of our shorter term trading strategies, owned treasuries last month, and we just closed out that position. And in another position, we're actually short treasuries when our income is more of a hedge. So there's different ways to play it depending on the type of strategy and really depending on what else you're trying to do. I mean, if you're trying to protect yourself from rising rates because you own a lot of interest-sensitive securities, you need to potentially hedge that. So it could be we could see another spike. Certainly the U.S. economic data that's come out the last few days has been better than expected. You look at the manufacturing data, is better than expected. You look at the services data that came out this morning, better than expected. Railroad traffic continues to do well. So, housing is improving still. So our economy is still doing okay, and it's doing better than the rest of the world. And on top of that, our interest rates are still very low. So stocks still seem to be the place to be. The stock market does seem a little bit lethargic the last few days, and you notice some of these, how it's not closing. These little candles tell you it's not closing at the highs, whereas when it's running up like this, it was closing near the highs during that whole run in late August. But if you go back, pardon the lines here, but if you go back to, let's say, even earlier in the year, you'll notice that after we had this big V bottom here, remember we had that earlier in the year, we had this V bottom where it went down like this, then it came back up, then it kind of just moved sideways for a while, started to get a little weaker, and then off to the races we went up again. So it wouldn't surprise me to see we had the V bottom kind of moving sideways. Do we drift? Maybe we pull back a little bit. But on the down days, there isn't a lot of intensity. So I still suspect that we are going to go higher. Again, we're always susceptible to a correction. Okay, that can happen for any reason. Nobody's going to be able to predict when we're going to have the next 5, 6, 7% correction. But the formula that's been working is to buy each one of those 4 to 5 to 6% dips. It worked again in August. It worked back here in February. You know, it's worked for a long time, and it will continue to work until it doesn't. And when it doesn't, you'll know, because you will buy it and you'll immediately get stopped out. So, but for right now, the stock market is a little lethargic, but at the same time, again, where else are folks going to put their money? Emerging markets have been doing well, but the developed markets have not. But the U.S. is still the place to be, and more importantly, the larger companies. If you look at the Russell 2000 still only up about 1% on the year, so has not performed near what the S&P has done. Dow Jones, what's interesting about the Dow is the big kind of mega cap. Dow Jones hasn't done that well this year either. It's done okay, but not like the S&P 500. So folks are still borrowing money at low interest rates, and every time the S&P 500 dips, they are buying it, and that's what these little V-bottoms are. And I don't see why that would be any different this time. So watch for us to maybe make a run to the upper side of this channel over time, which is only another 3% up, and then maybe we start ebbing and flowing back down again near the bottom, and that continues. Now, oil had a big day yesterday, down a little bit today. It had a big reversal today, or excuse me, yesterday on Wednesday, and it came after that big drop we had the day before. So we saw a big drop the day before on Tuesday, and then on Wednesday I had a big jump. Oil's still at this very key level here because, yes, it's technically broken, but it's close enough. And, you know, if it breaks any further, I think you could see, you know, the mid 80s at least. And, again, you look at that from two different perspectives. Yes, there's a lot of production. On the flip side, are we not getting the demand and because the economy is so bad? Or is it just that we just have too much supply? What is it? And nobody really knows the answer to that. But what we do know is that this is helping consumers. Oil prices falling, gasoline prices falling. This is helping consumers. Some various agricultural commodities are falling. That's helping consumers. So, again, I think it does look like a kind of a Goldilocks scenario for stock investors and, more importantly, U.S. stock investors. And, again, our data points to it. So that's really the main thing going on. If we take a real quick look at gold, kind of this not much to do with gold here. I think, again, if you're watching gold and trying to trade it, it's real sporadic. If you own a little piece of it as a kind of a core position, then I think it's fine. But if you're trying to see what type of edge it is right now, there's nothing really doing in gold. I would point to financials real quick as one sector we're watching. You notice financials broke out here recently despite interest rates being really low. So if interest rates do start to rise, and David Tepper's correct, what's going to happen is long-term interest rates go up, the Fed keeps rates where they are, the yield curve, they call it, is widening, which is more profitable for banks, which are in the financial sector. And so financials could keep doing very well here in a rising rate environment. Again, depending on what else is going on. So watch the financials. I think that's an interesting area. Hey, real quick, I did want to let you know we're doing another investor CrossFit session. We did one in Houston back in August. We're doing one in San Antonio September 16th. It is on our website. It will be September 16th. It's going to be from 7 to 9. You can go on there and get all the information. You can either register online or you can call our offices as well, 210-526-0057 to register. But it will be in San Antonio this time. Did one in Houston that went real well, and everybody seemed to like it. So register if you're in the San Antonio area, or if you're in the Houston area or Dallas area or Seguin or Eagleford Shell, wherever you are. Sometimes we do have people drive in for the event. So make sure you sign up for that. It will be on the site. First thing you see when you go to eggerscapital.com. All right, guys, have a wonderful rest of your day, and we'll talk soon.